Good afternoon, everybody, and my fellow speakers, Hans-Jürge and Schmitz, hello.
Hello, Rajaa.
John Holloway.
Good
Hi,
afternoon.
John.
Hi.
And Ken Pentimonti.
Hello, good afternoon.
So this is quite a unique format in terms of webinar today by the LPEA. It was supposed to be an event held in London on the 17th of March. But because of the situation, we had to virtualize it. We still hope this will be a very real event for you because we've been very much looking forward to bringing all of us together as LP and GP experts, bridging the gap between venture capital and family offices. We have two founding members of LPEA with us, with Hans-Jürge, who's a German, landed in Luxembourg almost 30 years ago, married to a Belgian, and founder of Mangrove Capital. So he's very much the epitome of venture in Luxembourg. Another epitome is John Holloway, who's been 30 years with us from Sheffield. And his career spans 3 decades with the European Investment Bank, including 2 decades at the EIF, European Investment Fund. And he's going to be our star speaker, telling us his stories from the ground. And last but not least, we have a Silicon Valley boy, Ken, who is one of our more recent joinees from Paladin, a venture capital firm from the US with offices in London and Luxembourg, of course, where they have a number of structures we will talk about. And between all of these gentlemen, we have a lot of children, a few grandchildren, but also quite a few dogs. So if you want to know about that background, please send us questions. But today the topic will be really to understand the appetite of family offices for venture capital from different angles, and more than ever, because of the current pandemic hit, we ask ourselves whether this is a relevant question. Before we jump into this, since this is a secular trend, you know, that family offices are into venture, we wanted to share with you a few statistics, because at the LPEA, we have a group dedicated to single family offices. And you should see now on your screen a few slides that we will share with you over the next 5 minutes before we jump into the discussion. And also, so you know, everybody knows there's a lot of wealth worldwide. A few statistics here show that about 20,000 families today represent more than 700 million each. And that gives you the scale and magnitude of how much dry powder is accumulated among single family offices. Some stats from Camden Research, which is a little bit of the household name in this field, where you see that we have close to 8,000 single family offices worldwide, with almost half of them in North America, but emerging markets like Asia Pacific catching up fast in terms of the number, and it's a growing world. And here we see that the total wealth is estimated at almost 10 trillion. Of course, this changes according to the source and the methodology, but the order of magnitude is very much valid. And within this world, the same research shows you that private equity, whether in funds or directs, accounts for almost 20%. Actually, these numbers are from last year, the year before, so I can only say that the allocation is growing. The reason being that everybody knows that family offices are gaining ground as LPs within our world of PE, and this is a kind of acclaimed trend from LPs across the board by Prekin. What happens in effect is that, for instance, over the last 5 years, you see that and up to 2018, family offices doubled in terms of their investment in PE. These are statistics gathered with the help of INSEAD and Prekin again. And in terms of their learning curve, and this is something we'll talk about, usually family offices start as passive investors in fund of funds before they move all the way into the direct route. And we'll get some live cases today with pros and cons about moving to that phase. So all in all, in the last 2 years or so, you see that although it's only 2% of the total capital invested in PE, family offices represented almost 20% of fund raised. So that means they're the second largest source of capital for private equity after pension funds. And this is why we decided to do this. Within this context, you see that all direct is a big deal, increasingly so. And the reason is that for family offices, trust is paramount, sometimes even overtaking the importance of a track record. And every survey that you run from different sources confirm this trend. This obviously is all before pre-C19 and extends into the venture space. That is our topic today. And you see here that the volume of deals done by families is almost overtaking on the right-hand graph the deals done by the VC firms. So for some, the new LPs, actually the family offices, at the expense of VCs. Let's see what Ken and Hans-Jürge think about that in a bit. And that means that they are a force to reckon with, and we couldn't ignore the topic. At the LPEA level, we have about 25 members that are family offices, and all these trends that are listed for you in these last slides are trends to keep in mind when it comes to families. I mean, some even say that they've become the trendsetters. So if you want to learn more about this group, please reach out to us. But let's go back to our fellow speakers today. And without further ado, unless you have any remark to do on the slides that we introduced this debate with, I'd like to hear the story of John. John, you are our venture capital advisor in chief at LPEA. We're very happy to have you on board. You're kind of keep us in check because no one amongst us has over 20 years of hindsight in terms of what's going on in venture capital in Europe in particular.
You're very kind, Rajaa. Thank you very much, and good afternoon, everybody, from my front room in Luxembourg, which is not where I was expecting to be taking part in this particular event. I was hoping to be in a very nice house in Belgravia, but just my own home now that I've lived in for many, many years. Rajaa is quite right. I think what she's shown us there in 5 minutes on SFOs has taught me more than I ever knew. And I'd like to come back to SFOs just at the end of the next few minutes presentation, just to give my own feeling of how I worked with them, particularly in the last few years. Just a few details on myself, if I may. I am now a happy part-time pensioner. I reached my biological sell-by date almost 2 years ago, and I've been working part-time with one or two little things linked to the industry ever since, because it was something which I did not want to give up at all, and certainly not entirely. So I have this role with LPEA, and I also sit on the board of a fund of fund structure here in Luxembourg, investing in small mid-caps and venture capital. I did work at EIF for almost 20 years. I started off there, when I started off actually in 2000, there were 4 of us in the equity investing team. We had about 500 million of other people's cash under management, because EIF does work as an asset manager, using its own balance sheet as well, but certainly mainly investing other people's money. By the time I left that job 17 years later, there were 84 of us with 18 billion under management and a portfolio, an active portfolio of over 500 European general partners. So we grew the business quite a lot. So very interesting, really. During that period, I went through with the rest of the team 2 crises. In fact, we walked into the first one when we began. It was the Neue Markt crashing, the VC time at the turn of the millennium, and then of course 2007, 2008, the securitization driven crash that caused all the problems it did. And here we are now, just a few years later, sitting in crisis number 3, where nobody really knows what's going to come out of it. All I could really say is that my experience was that those 2 prior crises were really bad for the business, but actually the vintages which came a couple of years after the crisis were the best ones that we saw at all. And so there is good that comes out of bad. And the coronavirus, which is causing so many problems today, who knows in 2 years' time, we have to hope that life will get back to something like a new normal.
John, most of your career was before coronavirus, so
it was indeed.
Tell us more the war stories of the time.
Absolutely. I think the word that I would pick out of your presentation, really, Rajaa, was trust, because it is a business where trust reigns. VC in Europe is still relatively small and most people know each other. And the trust that is built up over generations of fundraising. If you take the example of Mangrove, are you at number 5 now? I'm starting to lose count, HJ. Are you at number 5?
Yeah, we are at number 5, yes.
You're on number 5. Well, you're an excellent example then of someone that EIF, for instance, knew for many years, has invested in several of your funds and been very happy to, and was in you at the beginning when you really needed support, and has stayed with you as a partner, hopefully a reliable partner, pretty much ever since. So in that respect, a very good example. Ken, you're more recent, when you came to your company, came to establish yourself in Luxembourg and attracted some EIF support as well, doing exactly what EIF wants to see people do, investing in early stage tech companies, taking them through and building them into bigger.
But John, are you comparing EIF to family offices then? I mean, is it the same way of thinking and investing? Because I want to understand the perception of our two.
Rajaa, you're jumping my gun. You're coming to my conclusion. That's absolutely right. I do see, maybe HJ and Ken can tell me different, but I see a lot of similarity in philosophy between EIF and the family offices, in that they are not necessarily just trying to find a participation in the big names, the well-known names, the so-called top quartilers, top decilers, that there's something more to it than that. There is dare I say, a development angle that is married with and to the commercial angle. The return angle is absolutely paramount. We want the money back because we put it back into the market again. But there is more to it than that. If you're a VC investor, or if you were a VC investor at the turn of the millennium in Europe, then you could argue that you were certainly developmental. And since the crisis, 2007, 2008, EIS portfolio has grown exponentially. In VC, it's a little known fact and few people will actually believe it, but the highest or the best returning sector in EIS portfolio is early stage biotech. And that does not mean that everything is not particularly good, just the opposite.
Which period are you talking about?
Sorry, which period? Post-second crisis, post-2008, 2009. That's when a lot of people who had been working in corporates and elsewhere suddenly found themselves without a job. They teamed together and, becoming first-time teams, were able then to attract sufficient investment support to do some quite remarkable things. And I think the quality of the VC sector in Europe today is absolutely brilliant, really tremendous. And that's based on a large number of first-time teams coming out of the crisis who were able, one way or another, to attract support. And that, I think, if I may just say, that the real issue I see today is the first-time teams will yet again have an even more difficult time to raise money, as certainly the institutional investors, I would expect to do their move away from first-time teams. On the other hand, the family officers, who when I started the job in summer 2000, I simply were not part of any part of the area I knew, they weren't there. If I look at where they've got to today, it's quite remarkable what they're doing. They seem to me to move quite quickly. They can make investment decisions quite fast. A lot of them are tech money driven. So they're happy to go into areas because actually they understand those tech areas quite well, because a lot of them have actually made their money in areas of tech.
So I see our friends here, HJ and Ken, nodding. So because HJ, you were mentioned as the poster child of what EIF likes. Is it true what John is saying, or is he already delusional?
I'm making it up.
No, certainly not. How could I disagree with John? No, obviously we've been acquainted with EIF from the very early on. We were born in March of 2000 of all years. There was obviously the NASDAQ crash for those in the audience who remember. So this has been a long, long time, and EIF was one of our first cornerstone investors and has been ever since. And this is now 20 years of history. and very happily so. I think I would slightly disagree, but if we look at the topic now and compare EIF to family offices, and I guess that was one of the topics. First of all, I would say that there's a few things to mention. One is family offices, and the appetite for family offices for private equity and venture capital probably alike has risen tremendously over the last certainly 10 years. Although family offices have always been part of our investor base from the very beginning. Initially, it was regional ones, and then they became more and more international over the last 20 years. So that's an undeniable source of investors for our funds, and we see a rising presence. Now, I would separate them out, though. Probably there's old money, there's new money, without any judgment here. The old money, if I look at the first 10 years, let's say, of our history, it was more first-generation entrepreneurs who've just withdrawn from their operating business, started to invest their own money, and I would speculate to say that I would probably not be off by saying that venture capital at that time was very, very, very rare species. And the trust level that these entrepreneurs typically require when they enter into a financial relationship with the subject matter, i.e. venture capital, and particularly early stage in tech, it's taken some time to develop that trust relationship. Also with the
but
subject.
HJ, when you say there was no venture and hardly any family money, I mean, I've been investing in venture now for 10 years, so I don't know what was happening 20 years ago when I was on the other side, but for sure, US venture was very much present. And so has the European scene just caught up? And then we should get Ken's opinion, but please, what do you see?
Well, certainly, I mean, Europe is about 20 years behind probably the US when it comes to venture, certainly. So some of those phenomena that I was just describing are probably already like boilerplates in the US before 2000, but I'll let Ken comment on this. Just a last comment. There's the new money, and John referred to this. These are probably the last 10 years, and this is certainly a change that we have seen. A lot of tech entrepreneurs have come to the scene. They have made their own money, and they're the first ones to reinvest that money into investment opportunities, i.e. startups or other venture or private equity strategies. So we've seen a tremendous rise also in interest from these kind of groups, and that's across Europe, but also probably globally. So.
And Hans-Jürge, I know most people know probably, but you invest in Europe and Israel, right?
That's
Since
correct,
the beginning, not in the US.
Correct.
Okay, so Ken, Silicon Valley.
Yes. Hello. Well, good afternoon, everyone. Yes, we come at it from maybe a little different angle, being history. Our history and roots are in the U.S. We are on our fourth fund. Raised our first fund in the U.S. in 2001. So we've been around almost 20 years now as well, but much newer to Europe. Our first three funds were all U.S. North American focused. With the raising of our current fund that we're investing out of, with EIF and LFF as cornerstone investors, we came to Europe. I came and led our effort to build out a team and to start investing actively here in Europe. We are cybersecurity focused, so we're a little bit more narrow. We're industry focused. We have a broad definition of cybersecurity, but we do not look across all areas of technology. But for a long while, we've seen cybersecurity as a global issue, and we knew that there were a lot of interesting opportunities and things that we were missing out on by only being focused in the US and North America. And so coming to Europe for us made a lot of sense strategically. Even in the 5 years we've been here, we've seen continued growth in the venture sector here. It's been an extremely good experience for us. We've seen a huge amount of activity. Cybersecurity is, as I said before, a global issue. It's one where lots of very interesting companies are being developed here in Europe, and 40+% of our current fund, we've invested in companies that are either headquartered or primary operations here in Europe. So we've been very active.
Yeah.
A significant portion of our LP base is family office. Yeah, we are newer here to Europe, so it's a smaller number of European family office, but we do have a significant number in the US and other parts of the world.
But
so
Ken, sorry to stop you for the knowledge of our audience. You mentioned
Yes.
EIF and LFF as cornerstone.
Yes.
So who is LFF? Because most
LFF
of us
is
don't know.
the Luxembourg Future Fund. They're affiliated with EIF, so EIF helps them manage the investments that they make. And it's a fund focused on investing both in funds and companies, so direct investments in entities that are in Luxembourg and focused on developing jobs and creating businesses, growing businesses in Luxembourg. So they've been a fantastic partner. It's the reason we're in Luxembourg, the reason we've invested in Luxembourg, and we can talk later. We have one of our companies that we brought to Luxembourg and have located there, and they've grown their business nicely in and around Luxembourg. So lots of advantages in being there.
Okay, so let's stay with family offices. So I have a double hat today for LPEA and for a family office. And something that surprised me in our stance is I thought that with COVID, we would change our appetite and kind of vision of the world of venture, but actually not really, because somehow tech and in particular early stage and certain niches have remained very strong. So maybe HJ and Ken, since you have a lot of family office as LPs, and I know a few, what have you seen in terms of the appetite of family offices for what you do over time, and especially now with the pandemic? And then John, you can always contradict us if you think we don't follow. You're the boss. You're the boss.
I'm just waiting for an opportunity to come back to HJ on his 20. Europe still being 20 years behind America. I think 20 years ago I would have agreed with you, but 20 years later I'm not sure we're still 20 years behind.
So where are we?
Okay,
That's for later if you want.
So HJ, do you backtrack? You can backtrack, huh?
No, I don't backtrack on this one. I think we can. There's certainly arguments on both ends. But coming back to the topic, I think if I were to compare again EIF and family offices, the one thing that is certainly very similar is once you gain their trust, they're a very long-term loyal investor. Which is not to say that institutionals generally aren't, but I think investment strategies at institutionals tend to change more often in time. At least that's been our experience, particularly post the 2007-2008 crisis. There's moments where you would thought that, like, for example, big endowments in the United States were a safe bet for the long run, and they weren't necessarily, because they had their own internal issues post the crisis, for example, and they shifted their investment strategies. Whereas family offices has been, in our experience at least, a lot more stable. Go ahead.
No, I just want to jump in there because I like it when funds have a cornerstone like EIF. I think the big difference for me as an investor is they do much more detailed step-by-step process-oriented due diligence. And we are much slower, but for a different, not slower than EIF, but slower than a normal investor, because we want to build that trust. And although the process is not so structured, and I know I love the back and forth with the GP over time, it's like going from a first date where everybody looks, his best. And then as you date away, you see the real people revealing themselves. And then I cross-check with other families and check other deal flow with them. And I love this kind of interaction, which builds like almost a spirit of community, which I'm sure EIF doesn't have the luxury to do.
Well, I think coming back to the dear old EIF, the number of teams who EIF sees on a monthly basis is extremely high. We see all kinds of people from all kinds of backgrounds, quite absolutely remarkable. And there's only a certain number that EIF can invest in. I think when I left the place, round about 20% of the deal flow in any year might get an EIF commitment, which means 80% does not. There's always been an excess of demand for EIF money than the the sheer amount EIF could do with its resources, financial and human. And that sets quite a tough objective for the fund managers who come to see the EIF teams, because they have to come with the obvious stuff. They've got to have a good business plan, good-looking team, CVs that match, the obvious stuff, really.
Good-looking teams. Well, thank God we picked these two good-looking guys today.
Absolutely, only good-looking people are accepted on that side of the table. But really, when it comes down to it, if you have to differentiate between 2 or 3 teams who are in a similar investment space, are probably first-time teams. So why would we go for Team John Smith rather than Team Madame Dupont? In the end, it becomes subjective. You can use all the objectivity you want, but it becomes subjective at the end. And you hope you get it right. And I don't mean to be facetious when I say this, when people frequently ask me, well, what is the difference? How do you make this differentiation? You see a lot of people, a lot of business plans very similar. And for me, it was very simple. It's bright eyes. If you see a team that comes in and is absolutely determined to get through, and not all of them do, I've seen some along the way as well where it's got a bit hairy meetings. Bright eyes.
It's funny what you say, because I always ask the team, especially the first-time team, what is your plan B? So if this fundraising doesn't work, what do you do? And normally they shouldn't have a plan B, right? But Ken, so you're among the 20% who are lucky to get into EIF. Is it the same fail rate with families? 80% say no?
You know, I think it is. I think it's maybe a little bit different. But yeah, with families, it's certainly a low percentage, even with families. And I think maybe though for the different reason that families are looking for specific funds and specific areas that that meet their backgrounds, their experience, their knowledge base. So, for instance, we're a cybersecurity or deep tech investor. Many of the family offices that we invest in, have maybe the family money came from technology investing, or 1 or more members of the team have background in deep tech investing and have embraced our industry focus, our type of investing. And so that's not the case, obviously, with all family offices. And so there's some that we're just not a fit for, but the ones that we are a fit for, it's a very good fit. They understand our business. They dive in deeply into our investment thesis, and have, as HJ mentioned, I think we've developed very strong long-term relationships. They're also very interested in co-investing with us.
You said the C word, the other C word.
Yes, the other C word. And that works out well for us. We don't open it up for every one of our investments for them, but for the ones where there's additional capital available and we think we can syndicate a larger round, we will open up for our limited partners, many of them are family offices that are interested in co-investing, and that's worked very well. We have a number of our investments in this fund that we've done that, and that's a good thing for the family offices. We think good thing for us to be a little bit more active, be a bigger part of the rounds that some of our companies are raising.
Can normally we get offered co-investments with no fee, no carry? Is it the same for you?
We've got a bunch of different relationships and arrangements with our different limited partners. We like to actually have them come in through us, just because we feel like we can be it's a little bit more straightforward for the companies that we invest in, and it allows us to vote in more of a single block and have a little bit more say on an ongoing basis with our portfolio companies. But as I say, kind of depending on the investor and the situation, we've got a various different types of relationships.
And can I ask you, Ken, do the family officers stay with you during the investment period? In other words, are they interested in seeing what you're doing with the money, or are they passive investors? Do they come to your board meetings and how shall I put this, cause trouble? Do they ask deep questions, or do they pretty much leave you alone?
It's interesting. We have a wide range. In our case, it's all of the above. We have some that are very active, especially the ones, as I mentioned before, that come from the industry, and I think it's really dive deeply into each one of our companies, look at each one of the co-investments. There are others that are very passive. You know, they just rely on our expertise. We've been doing cybersecurity now for 18 plus years, and they trust us and just look at their quarterly reports and may ask a few questions from time to time, but are for the most part passive. Mm-hmm. So it's a nice range. I would say some of them can be very strategic as well. They come with lots of very interesting relationships that we can bring to our portfolio companies that can be helpful. And so you know, we try to leverage that as much as we can.
I see HJ making a strange face. I know you don't like co-investments, but
you had to rub it in, right?
Yes.
Let me be a bit more nuanced here. I think first of all that if we look at the broad spectrum of private equity, including venture capital, I think there's a difference to be made here. Both are obviously a source of significant performance, but the genetics are very different, and I would assume Ken would agree. In private equity, out of a portfolio of a fund, let's say, as an example of 10, you probably can assume as a thesis that 8 or 9 out of those 10 are going to produce some form of return. So if you were the co-investor, or let's say the LP, and who has a co-investment allocation, you would have a relatively statistically high chance that even the money that you put in directly somehow will yield a return. That is not the case in early stage venture or very deep tech venture, where the success ratio is a lot lower. And mm-hmm. So if you allow LPs to co-invest, there's if they were to do it in a direct way. And for the anecdote, for example, one of our sort of character building investments we had back in 2003 was Skype. And we did expose this obviously to our LPs, and none of our LPs wanted to co-invest.
Well,
and I'm not making this, I'm not criticizing the LPs for that. There is obviously a lot of creativity required and a lot of like crystal ball mm-hmm. to imagine what some technology like Skype could leverage. But and so in the end, you always get to return the question.
Yeah, your line is not so good for a tech investor, HJ. Can't hear you all the time, but something else. Uh-oh, you're gone there. Hans-Jürge? Okay. You froze there for a minute. Yeah, but we lost you for a bit. I don't know what you said, but we'll come back to it. I know we like co-investments if we understand what it's about, but something else a lot of families like that we don't always look at is sustainability. And for instance, as Hans-Jürge, you have K-Health in your portfolio. Could you consider this a sustainable investment? And then it would be great to hear the EIF veteran and Ken about this topic and what it means, you know, for you guys, because for the next gen family officers, at least it's a big deal, huh? Whether we like it or not.
Well, sustainability, you mean? Mm-hmm. Well, you want me to?
Yeah, because you have, I know you have K-Health in your portfolio, first, and I know Ken has cyber hedge, so.
Right. So, first of all, it's a key example of where family offices get really excited about it because they do understand the general use case here. And it's a global use case, and it's a long-term investment focus for K-Health, and of course an industry that is in the midst of a tectonic shift essentially when it comes to digitalization. So and I think that creates part of the empathy that you can see, for example, from family offices. And we've had multiple instances where our LPs and LPs of other investors into K-Health were looking at this because it's such a pervasive potential. Whether they call it sustainable or not, it's always a question. That the health sector obviously is has a sustainability aspect to it. Whether K-Health or any other portfolio company will be sustainable in the end is a question of how well they ultimately propagate their offering and their product into the market. cyber hedge, I don't know much about, so maybe Kim gives us a bit of a background information there.
Sure. Yeah. No. CyberHedge is a company that's doing risk assessments for large enterprises. So they're taking a look at companies and looking at their cyber health and whether they're doing the right things internally to to make sure they are as protected and doing the right things to allow them to operate in a secure way. And so it's very important. And I think the COVID-19 situation now just shows how reliant we are on technology and how many potential weaknesses we have and what a dramatic impact it has on a business if they're breached and there's cybersecurity issues. And so we see something like what CyberHedge is doing, which is giving you basically a report card, giving you a sense as to how you compare against other companies, other companies that are similar size and similar industries, how you shape up and the things that you could do, to make yourself more secure. We see that as sustainable. It's something that I think longer term, there are virtually no businesses these days that aren't digital, that aren't online, and so doing things where you are allowing yourself to interact with customers, partners in a more secure way, we think is critical. It's not a nice to have, it's a need to have, and it creates sustainability over a long period of time. That's CyberHedge is a company that the CEO is American, but we had them locate their business, their headquarters, at a very early stage in Luxembourg as part of our investment, and also LFF, Luxembourg Future Fund, co-invested with us into CyberHedge. They started their team in Luxembourg, have grown, have hired a number of people there, and continue to have the growth stay there. So it's been a great case study for us, and it's a business that we think we can replicate. We think we'll invest in other portfolio companies as we go in a similar fashion.
And that was an argument to attract family LPs?
Yeah, I think it is. Absolutely. I think to show that we can locate businesses in locations that have co-investors like Luxembourg Future Fund that are in areas where there's high quality tech talent, areas where there are large customer opportunities, financial services and other opportunities that the company's been able to take advantage of. So that's a great case study for us, and I think it resonates really well with family office LPs.
There's a few more things to talk about, like Luxembourg. Indeed, it's a good transition. Also wanted to ask you about, Hans-Jürge saying earlier that family offices were very sticky once you get them. So first, how do you get them, and then what makes them? How do you keep them? And of course, I wanted to wrap up with some advice to venture funds who want to raise money from Luxembourg or from EIF, and from, of course, families. But also we have a few startups listening to us, and you giving them advice about, how does a family decide to go direct into a startup? So these are all the little and big questions I'd like to cover before we wrap up. And I saw that John was moving around a lot. So what did you want to say that you couldn't say so far, John?
No, just from the investor point of view, the subject of sustainability, and in a wider sense, everything to do with ESG, which I think a few years ago was something which was a subject that was mentioned but not really understood, and was seen as a rather, I used the word earlier, philosophy, a slightly philosophical aspect that we could all do without. It didn't really matter, because what you really wanted to do was get a team who would give you your money back. And in the space of a very short period of time, I think the whole question of sustainability and ESG now is absolutely mainstream. It's as important as your business plan.
But why is that, John? I still see a lot of families who despise this notion.
They despise it, don't they?
Yes.
Right.
Still, there's a bit of convincing to do.
Yeah, it may well be. I think in that case, that is a difference between EIF and institutional investors. Not say all of them, but my feeling is that with the institutional investors EIF has been dealing with in the last few years, the sensitivity to the subject of anything to do with ESG has become massive. And to the extent now that it is absolutely part of the due diligence process, that a fund manager has to demonstrate a likely ability to fall in line with the requirements in this particular subject. And if not, there were some investors, I think the Dutch pension funds were some of the biggest users of this in the beginning, who, even if they see a fantastic team, will not necessarily sign up.
Do you agree, HJ?
For me, it's the biggest single change in LP attitudes in the last 4 years.
Okay, so families say that to you, HJ. I know in your LP report you have a section on sustainability of some sort.
Yeah. I think I'd say that I can't talk for the entire environment or ecosystem of the family offices. I think there's a wider variety of those who do care about it as much as probably institutionals do nowadays, and I would absolutely agree with John that this has become mainstream over the last certainly 10 years. I mean, I could provoke a little bit. I think Warren Buffett at one point in time, not so long ago, said, well, first and foremost, I'm interested in performance, and whether that has ESG or with it or not is secondary. I'm paraphrasing and probably incorrectly. So I wouldn't go as far as saying it's a luxury. Certainly isn't, particularly in today's day and age, and coming from Europe. I mean, we have these huge challenges, particularly on the environmental front. I think on the governance side, we stick to the highest standards here when it comes to governance within our portfolio. In the venture space, I think it's mostly the sustainability area that is sort of rising above the fold. And when it comes to family offices, it's becoming, I think, by my observation, it's becoming more and more a subject of due diligence also on their part.
But it feels to me it's a little bit like International Women's Day. Eventually we should abolish it because it's irrelevant, and sustainability should become mainstream and what everybody does. And this is where the argument within families runs to say, well, why are we even talking about this? We've always thought as a sustainable investor. And then there's the argument of greenwashing, and that a lot of funds just put the stamp on their reports to look like they're green, but they're not. But anyway, that's an endless debate. We should do another topic session.
That is one for a separate session.
Exactly,
that's for sure.
exactly. No, I want to go back to Ken's argument about Luxembourg. So Hans-Jürge, the LPs you have who are families, are they from Luxembourg, and are they different from the others?
Certainly the early ones, and still part of our LP base, and the most loyal ones, the longest ones, come from Luxembourg. Yes, absolutely.
So because this is a big message for LPA to say you can fundraise from Luxembourg, from families, if you try and if you get the right recommendations. Do you agree with that statement?
It's a question of recommendation, reputation, and ultimately performance. But yes, you can, of course. Now the ecosystem is obviously not as big as it would be in the US. In terms of sheer numbers, you mentioned some numbers as well, and I think you said 50% of that wealth, or at least that number, is coming from the US. What we see, for example, is a lot coming from Israel and a lot coming from Asia Pacific, including China in this case. A lot of wealth having been created, particularly from on the side of tech entrepreneurs over the last 10 years, and they're reinvesting it and diversifying their portfolios. And for us, quite frankly, it's also a matter of getting access to those markets for our portfolio companies through those type of LPs as well.
That's true. That's something we didn't discuss. Families are a source of deal flow as well for the VCs. And
they're a source of deal flow, but they're also a source of inroads into a market. Right? If you have the family office of Tencent founders or origins, then just to use an example, that gives you prime access to knowledge, at least, about those markets.
Can any Luxembourg-based families as LPs for you?
We don't, not to date. We certainly would like to have some going forward. We think that makes a lot of sense with our Luxembourg location, with LFF and investments and EIF. But no, not to date. Other parts of Europe, US, Middle East, Asia. So we've got a very, very global LP base. But yeah, couldn't agree more. I mean, I think the family offices can be great sources of inroads into markets, into geographies, very helpful with deal flow. I think for us, we spend a lot of time interacting with our family office LPs and try to engage them as much as we possibly can.
So John, there is a difference I just thought about between EIF and families. Is EIF, anybody can ring your bell and say, can I please come and present you my fund? Family is not quite so. So HJ and Ken, and then I can of course provide my own opinion on this. How do you open the door the first time of families?
Yeah. I mean, for us, it's it's I guess first and foremost is just relationships. So folks that we know directly, maybe they've invested with us in specific investments previously. We know them in the industry. We know them indirectly through our networks, and we've got warm introductions into them. In a few cases, in some geographies, we're not as well, or don't have as much of a presence. We've used some advisors that do have those relationships that then can make the warm introductions. I think you made the right point, Rajaa, in that it's very hard. It's very much a relationship game with many of the family offices, and it's hard to, virtually impossible, just to get a list of family offices and call them and
actually we were approached on LinkedIn by a provider who was selling Excel tables of families across the world, but of course 80% of the names were redundant or not appropriate. Yes. And even if you email or call, it doesn't mean, I mean, cold calling families doesn't work yet, but cold calling EIF works, huh, John?
I wouldn't know, not anymore.
I mean, there's a bit of time for Q&A, but there is one question I want to direct again to John, and of course to all of us is, John, so what has the other C word, C19, changed for EIF from what you understand, and in terms of VC appetite, or if anything?
I think when I say I'm outside the building now, I've been outside the building for a year and a half. The single biggest change is physical. Everybody is teleworking. The EIF took a decision to telework en masse very early in the process. I'm talking to some of my colleagues in a business where everyone's been used to sitting in the same building for quite a while. And if you want to see someone, you walk down the corridor, get a cup of coffee and talk in what is, after all, an absolutely personal, human industry. To only be able to do that via screen work like this or down the telephone has become a huge logistical personal exercise for a lot of people.
Has it slowed down the investment pace of EIF?
I don't think it has, from what I'm told. I think the single biggest difference is that it's very difficult to coordinate a due diligence when you have 3 team members. First of all, you can't go on due diligence, nobody can travel. And when you're trying to prepare your conclusions to your due diligence trip, it's not easy if you're trying to do it by phone.
Could you invest in a team that you haven't met, let's say a first-time fund or a new investment?
Very, very difficult to do that. The whole thesis of EIF is that you have to see the people face to face, form an opinion on them. That's why there are always at least 2, if not 3 people in a team. So each one has their own opinion. That is not, we're not able to do that for the time being, but hopefully in the near future it'll come back. What hasn't changed and what doesn't really change in crises, not in the previous 2 crises anyway, is there isn't suddenly a massive fall off in people who want to invest, who want to become GPs in this particular industry. It doesn't disappear.
No, that's
good
true.
times doesn't mean there are more, and bad times doesn't mean there are less.
No, it's true. And
a lot of people looking for money.
Yeah, and from the LP standpoint, the same. I think anything that's been in the pipeline and advancing forward nicely, unless you were not convinced of your thesis. Oh, revenge time. Did you freeze my screen?
Yes, of course. Magic.
No, but it's true. Any deal that was happening and ongoing based on conviction, you wouldn't stop in terms of VC allocation. But maybe we've been already for the last 6 to 12 months more careful of investments that are high cash burn and high, these kind of up rounds one after the other when it comes to direct, and checking also venture funds that keep raising bigger and bigger funds without their market itself growing. So these are things, but I really thought we would just stop everything, and we did not at all. So Ken, are you raising money right now?
Sorry, Roger, can I just come back on one other thing there as well, please? That when it comes to EIF and EIB, the EIB is the house bank of the European Union, it likes to call itself, and I think it's not an unfair way of calling itself. Every time something like this happens, every time there's a major financial need, the bank and the fund are used by the Commission to run financial programs. In fact, if going back to the first great example of Skype, it wasn't EIF that invested EIF money into Mangrove. It was EIF who invested European Commission money into Mangrove as the Commission's agent. So that is still happening. There have been announcements recently of an extra 25 billion being made available for VC and guarantee products, with hopefully a multiplier of 8 times, taking it up to 200 billion altogether. We had the EFSI program in 2014, which had a massive multiplier effect. So the money is there. It is really the ability to get it out into the market, which is certainly more difficult, and certainly made more difficult by not being able to work in the same room together.
Yeah. HJ, what did you want to say about the whole change from COVID? Because you're not raising money right now.
Well, we're not at this very moment. And I think one of the things that possibly, and will come out of this COVID experience, at least in the next 12 to 24 months, is that investors, and I won't make a distinction between family offices and institutionals, are looking for probably more established firms rather than first-timers. I think that's to some extent an unfortunate but consequence, but that's what I've heard. And that may be one of the tangible shorter-term fallouts of this. Longer term, and I guess Ken would agree, I mean, in venture capital at least, you're in there for the long run. I mean, these are funds that run 10, 12 years. These are portfolio companies that we support from day one almost for 7, 8, 10 years, and sometimes even longer. So I would tend to say that despite the magnitude of the crisis we have here on various levels, from a venture cycle perspective, it's again a blip to some extent, and jumping to conclusions at this point in time, whether some particular industries or particular assets, is probably not warranted at this point in time. And yes, maybe the rhythm slows down a little bit, but it will slow down probably over the next 6 to 9 months, just to see how big the fallout is, because that's what we don't know. I think we've all been busy right now making sure that our assets are safe to the extent that haven't already been unstable beforehand, in which case they will obviously be suffering even more. But those who are worthy and stable and have substance, just make sure that they can survive that next 12 to let's say 18 months. And from there on, it will be the path to growth again, possibly.
Yeah. Ken is nodding.
Sector by sector differently.
Yeah, no, I would agree with that. Definitely. I think there's still a lot of capital out there looking to be invested. I think venture capital for sure is a longer term investment class. Family offices, as well as other investors that are investing in venture, are looking much longer. We're certainly looking longer term. It hasn't, this crisis hasn't stopped us from continuing to look at new opportunities. We expect that, well, it's certainly, it's limited visibility as to what happens here in the short term. I think, this is not a financial crisis, or at least not yet. There's certainly financial implications to what's happening here. But I think as you look longer term, we're still, we being a sector focused, cybersecurity focused, we still think cybersecurity is, very much going to be a need to have. People are going to continue to invest, even if budgets are slightly constrained here in the short to medium term. That our basic investment thesis is there, and I think that's going to be the case with our LPs, with our investor base. And I think if you feel strongly about the area you're investing in, you have a good long-term thesis that this is more of a short-term blip rather than having a long-term impact on the industry. I do agree that it's harder for first-time funds. It is a people business. You have to be in front of potential LPs. We have the advantage of being around for a while, and many of the folks that we're talking to, we have long-term relationships already. EIF is a good example. We certainly interact with them on a very regular basis as they think about investing in us. Again, it's a much different story than if they were meeting us for the first time.
Mm-hmm. So you're all saying it's keep calm and carry on, HJ? Because
absolutely. I mean, anecdotally, we heard from the market that some investors, and this is not ours, I'm speaking more neutrally here, just 2 weeks into confinement, were already asking the question, well, what's the NAV and the NAV impact of COVID? I mean, this is unreasonable to even ask the question. Think about it, at least for venture. Now, you may say on very volatile assets, very, let's say, private equity type assets, you could possibly see those impacts a lot quicker. But it's impossible to assess, and we'd rather keep calm and make the assessment first of all on the asset level, make sure that, as I said, they're stable, and we'll see what the longer term consequences are. And yes, again, there's some businesses like cybersecurity, like health. You mentioned K Health. They will even be benefiting from this, and there will be an acceleration in certain sectors in terms of digital adoption. I mean, if you look at the United States, how many dozens of millions of people don't have access to a general practitioner, and all of a sudden you have it in your pocket, right? And particularly in times like these where you can't even get appointments for various reasons, this is extremely tangible example of how technology can actually. One way
we cut through the market is to think of what are the nice to haves and what are the must haves, and this is how we're going to decide, I think, our allocation in venture going forward. So any discretionary spending, retail, not so hot, but any deep tech, disruptive technology that will keep the world safer and better will definitely be a go.
Even you mentioned e-commerce. I mean, this is a long past era to some extent, but they have been thriving.
No, I said retail, like going in the shop on the high street.
Okay.
Yes.
That is a challenge, yes, absolutely. But e-tail will benefit from this again, and will potentially become more attractive again, even from a venture perspective.
Because we have the wise man of Luxembourg as opposed to the wise man of Omaha yesterday. John, do you want to have the final word on this and advice for the GPs listening to us and for the two good-looking, bright-eyed gentlemen who joined us? And I want to learn from you as an LP as well. So what would you say in this world of venture?
The thesis I would say is that the crisis in 2008 was worldwide and pretty bad. What we have now, nobody knows the outcome yet. If you have a good business plan, you believe in yourself, you've got to start somewhere. Don't give up. Don't give up. Keep going.
That's great. That's why you don't give up and you stay with us. I mean, I still want to do this live. Actually, we wanted to do this in London and in Zurich. So let's cross fingers that in the last quarter of the year or early next year, we can all go together and meet the different investors who are interested in this webinar. I want to thank everybody for attending. And if we can't do it earlier, I mean, $100 question for you guys. Should we do this again in September? Because then more dust will have settled for our world. Yes, no?
Absolutely.
Delighted to do it.
Yes.
Great. So we'll get a survey to ask people if they want us back here. So watch this space. Don't forget to subscribe to the LPEA YouTube channel and send us questions for today's speakers. Thank you, guys. And don't look too much after your dogs, but enjoy the beginning of the deconfinement. It's in Luxembourg, at least it's looking good. So
indeed,
it's starting, yes, absolutely.
Wait, maybe there's a question.
There's a question here.
Yes, oh no, it's just about the recording. Yes, it will be available to replay as often as you want. We will send it to all the participants. Thanks again. See you soon. Bye.
Thank you, everyone.
Thank you, everyone.
Thank you.